Welcome to the 2022 Robotti and Company Advisors Annual Meeting. Thanks for joining us. Appreciate you making time. The format today is I'll be speaking first, and I'm Bob Robotti, and I'm joined by a couple of my colleagues, Curtis Jensen, Isaac Schwartz, who are going to be zooming in from London, Theo Meer, and David Kessler. The format is each of us will make a presentation, give you some ideas on why we're excited about what we're invested in today. And then we'll go to a question and answer period. And then also we want to highlight that on the screen itself, there is a Q&A button down below. And at any time we suggest, as you're listening to the presentation, you have questions, note it down. Otherwise you'll forget it or whatever else. So if you note those down and we don't have time to answer all the questions while we're running, we'll be sure to get back to you after with responses to any questions you have. So thank you, and that's it. Thanks. So I want to start off by highlighting what I think Robotti and Company is a community of stock pickers. And by that, I mean that there's two key elements. That's process and people. The first is process, and the process is valuation matters. And there's no substitute for bottom-up stock research. And that's what we do. We look for companies where the present value, the future cash flows far exceed the trading price of the stock. And we think today is a particularly opportune time because the market is giving us plenty of opportunities. The second is people, culture. The thing I'm probably most proud of in the 39 years since I started the firm is that we've been able to attract, retain, develop, be introduced to like-minded stock pickers. And that's a critical element. And what we've done is we've nurtured that. And that is the asset that we have that we think is distinguishing and differentiating, especially since what's happened over the last decade or so is, in general, active managers, of course, have gone by the wayside. They've gotten tired, they've retired, the firms have shrunk, a lot of different things have happened. And instead, we've grown the number of people here. And of course, we've been together for a long time. And that's a differentiator. And it's a differentiator today that is most important and most opportune for us. So we all know the biblical story about 7 years of feast and 7 years of famine. And of course, that's what stock markets regularly do. There are cycles that markets go through. One of those cycles is the economic environment favors one group of stocks versus the other. So whether that's the growth stock sometimes, whether that's value stocks other times, it does clearly tend to go in cycles. Of course, instead of a 7-year period where we've had feast and famine, it's really been a 14-year period post the financial crisis. And that's because the economic backdrop during that period of time, strangely, for an extended period of time, has really been relatively monolithic. And the key attributes that we would highlight are it's been a relatively low growth economic environment. Inflation has been extremely low over that period of time. And as a result, interest rates have been low to nothing to negative over that period of time. And what that's done is had a substantial and extenuating impact on the allocation of capital and why we think we've set up the opportunity that is in front of us today. And we'd also highlight that not only did the stock market maybe have a 14-year period of monolithic results where certain indices and certain groups of stock did well, that group of stocks actually started to concentrate down. So there's a select limited number of companies who have been the key drivers to the market's performance over time. And therefore, and here, in addition, you've also had the fixed income market has been on a 40-year process where rates have only come down. And so a dramatic bull run in the bond market. What's happened is we think that many investors have come to think this is the new normal. Capital is allocated thinking this is not a cycle. This is not the end potentially of a significant extenuated, elongated cycle, but instead the new norm. And we think that that's what sets up the opportunity for us. So what we actually phrase it is it's the myopia of linear thinking. Things have gone on so long that people are convinced this is the new norm. You know, what better anecdotal evidence could you have that maybe that presumption is wrong, other than you look at the cover story from the Bloomberg Business Week, inflation is dead. Of course, we've highlighting the fact that when those cover stories run, it's an interesting time that potentially is marking the turn in a macroeconomic situation. And then in in January of 2020, at the end of the decade, we wrote our letter to partners, and here's an excerpt from that. And in that letter, we suggested that markets do go through cycles, that there's a good chance that we were in the beginning and inception of a new rotation. Of course, we were premature because we didn't anticipate the advent of a worldwide pandemic and the impact that that had for 2 years on the world's economy that prolonged what had happened in the decade before. But this piece highlights, of course, that economic cycles are different, therefore the winners are different, and there's a rotation that regularly happens in public markets. So, here's a quote that we love and we think is so apropos, and it's from Rüdiger Dornbusch, who is a German-born economist who taught at MIT. And he highlighted this idea that in economics, things take longer to happen than you think they will. And then they happen faster than you thought they could. And so we think that that's playing out in so many ways today. The things that our bottom-up stock research had indicated to us in terms of businesses, and therefore some portion of the economy, indicated that there were trends underway that hadn't manifested that were very interesting and potentially would lead to a change in a rotation. And then, of course, we really would point out that in the last year and a half, things have adjusted very quickly because there really is a disruption from what the past monolithic economic environment has been. And of course, one of those things that's really changed today is the reappearance of inflation, right? So 2 slides earlier, we talked about the concept that people were predicting inflation was dead and that was the new norm. And so here we definitely have the advent of something that substantially affects the valuation and the pricing of every security and valuations, right? Because it's the foundation on which you build the risk-free rate of return. And it is in the process of changing, and no one knows exactly where inflation is going to stabilize at. Now, we would point out that much of the market is projecting that inflation will be tamed and relatively soon will return to a relatively benign and inflationary environment. And that's priced into many things today. So we think that there's a risk that the markets are in denial, and therefore they haven't really started to adjust yet fully to where we think are, because we do think that there's reasonable chance that inflation may moderate. Yes, but does it moderate where it was? Maybe not. And if not, that's different than most people's presumptions that's priced into securities today. So that's what we're highlighting clearly this significant shift in the macroeconomic environment that may be transitory, that we have reasons to think, no, there's more persistency to it than people believe. And that's causing significant changes in valuation. And you've seen that, right? You've seen stock and bond markets, this year have extremely difficult times. And so therefore, that's relevant. And that's what we also think. There's a lot of conversation that goes back to, well, the trend has happened last time, is this happens and that happens. So therefore, people have plenty of information and therefore try to impose those situations onto what they think will play out today. But we believe the idea that there's no substitute for thinking. When you intuitively think through, that is a critical element that potentially comes to a different conclusion than the market has today. The important thing, though, is for us, the North Star, and for all investors, the North Star is valuation. It is the cash flows of businesses that will eventually determine the market price of those securities. And what we have is a universe of companies that we know well, have studied for a long period of time, and have conviction about the sustainability of the earnings they have. And they've demonstrated those earnings over the last year or two. And because of those earnings, the financial position of those companies today is extremely strong. So many of those companies today have net cash on the balance sheet. In addition, trade for single-digit PE multiples. So clearly, on an absolute basis, extremely compelling investment opportunities. And then part of what also has driven this is the movement of capital. So much capital is now invested in passives, right? Passives are a larger component of the total equity market. And what happens with passive investing, right? It's not bottom-up stock research. The thing we do and continues to do and continue to perfect throughout the decades is something that we think is the differentiator. And the opportunity is set up by the fact that you've got such an elongated period of time where the best securities perform so well, and they did have a strong economic environment behind them that facilitated that, but the valuation and the capital continues to flow into them and out of other securities. And therefore, that's what we have now. We think there's a disruption and a rotation from the market leadership. And in that process, instead of owning 25 stocks that will outperform the aggregate of all other investments, those things are changing. And therefore, there's a dispersion that's happening. And therefore, that's why we think the opportunity. We have the little chart here that does highlight, the cycles that investors go through in this process. And we think that much of the money, because this year continues to come into passives, right? People are thinking, oh, it's down some, so let me buy the dip. And the question is, are you buying the dip or are you buying the next leg down? And therefore, we think the market is largely in denial in terms of those things that have performed well for such a long period of time, that they've attracted so much capital and have valuations that put them at risk. The other side of the spectrum, the valuations of things we own that have demonstrated their earnings capacity in the last year to two, we think the market is it's at the early stage of the uplift, and that is apathy and and disbelief in terms of the fact that these things are sustainable. And yet our bottom-up stock research gives us plenty of reasons to think that that's the case. Whoops, sorry about that. So that's what we think. We think the 40-year juggernaut in the bond market is a thing of the past, that free money, Fed money, plentiful money is over, that the price discovery is reasserting itself, and it's only beginning. So people are still in denial or apathetic on cash flows. The continuation and the ability of those businesses to generate those cash flows will convince investors and attract capital. Therefore, active management, we think, is extremely well positioned, and that's something that's a universality across all of our portfolios and all the people here at Robotti. All of our approach, we're in the right place. We know the companies, we've done the work on them, we understand dynamics, and you could see obviously the significant attractive valuations today. So with that, I'm going to turn it over. Isaac, I think you're next, and let me go mute myself and take my slides away.
Thank you, Bob, and hello, everyone. I manage the Robotti global strategy, and I'm glad about how Bob set the tone, because our global strategy, its evolution has echoed that of our firm overall. We launched this strategy in 2005, and our initial focus was Thailand. There were plenty of Graham and Dodd type of stocks to screen through, and Bob and I were combing through the market that was still in the wake of the 1997 Asian financial crisis. In other words, Robotti Global started out as a heavily quantitative strategy. Then in the last 2 decades, I've had a wide range of investment experiences around the world, which naturally cultivated a turn towards increased qualitative analysis to complement that classic bottom-up value framework that we have. I call this holistic strategy of ours being flexible and focused. The Robotti global strategy is flexible because it's a hybrid of emerging and developed markets, and it's in a range of industries, and it's a hybrid of quantitatively and qualitatively discounted value. Then it's also focused because of our long histories with the companies that are in this concentrated portfolio. From this flexible and focused mantra, an example is that we're excited about Ukraine, where we are invested today. This is a country that's in a difficult position, but it has evident advantages that are going to be in the spotlight in coming years. We're holding shares in Mironivsky Lipoprodukt, which is Ukraine's largest poultry producer, and it has more than half of the chicken market. This is a vertically integrated company, so it also produces other agricultural products like vegetable oils that are used as feedstock for chicken. And over 3 decades, it's a company that has proved itself as having an excellent management, including 16 years with a record as a publicly traded, publicly filing company. And I also believe Mironivsky has proved itself this year, in which operating income has actually halved from $400 million to $200 million. But that's happened with lower production and with some non-recurring charges that have come in to support the war effort. So overall, I see it as a pretty reasonable result. And yet the stock has collapsed, now selling down to only twice its current depressed level of operating income. This is the sort of business that could trade for a dramatically different valuation in a different sort of a world that could come a lot sooner than reactively pessimistic investors are acknowledging at this moment. Ukraine reminds me a bit of the country Georgia. There was a war in South Ossetia in early 2008, which was a scary time, and it was disastrous for the Georgian stock market. Their leading companies traded down around 90% in that year. And yet, those companies still made new highs within a few years. Aside from simply how cheap and undervalued they had gotten, what happened was the United States and Europe had a plan for the redevelopment of Georgia, which was sort of like a new Marshall Plan. It turned out to be a major stimulus to the country and to its best firms. And we anticipate that the same thing will happen in Ukraine. To date, money has poured into the country, but in the future, donors will check receipts. And a more effective way to help, instead of sending cash, would be to break down trade barriers and support what are already the most competitive goods coming out of Ukraine. In this regard, Miranivsky's chicken products will be very advantaged. They're a low-cost producer, as I mentioned, because of scale and vertical integration. And now they've developed value-added production, such as specialized parts that go through the supermarket channels and into fast food, additionally processed products, versus the home market where the birds just get sold as carcasses, not as the value-add products. So I'm excited with what we already have there, and we're also looking at further opportunities in Ukraine. And I just want to note that we don't dive in anywhere. I would note Bob and Theo and I were together in Ukraine a decade ago, and I've been back repeatedly since that time. Keeping to that region, I would be remiss if I didn't talk about Halyk Bank, which is extremely discounted. This is the largest financial institution in Central Asia, which is a region of 100 million people. It's in Kazakhstan. All of us have visited that region multiple times, and I noticed a few of you who have tuned in today have even been over there with us. Halyk just reported record earnings of more than $900 million in the first 9 months of this year, and yet the market cap is only $3 billion. And they pay out around half of their income in dividends. So you get to have a teens yield in what's a growing company, which I think is a great proposition. And I'm very bullish on Kazakhstan itself. When the region recovers, all of the countries in the region can have improved economic growth, including Russia, Ukraine, and Kazakhstan. But until that time, Kazakhstan has become a bit of a new hegemon for the region, which we're seeing this year, where there have been people and businesses relocating from other countries in the region into Kazakhstan, further supporting the economy. Talking about our perspective with this company, we've owned 3 different Kazakh banks over the last 12 years and have been investing in Halyk for 8 years. So we know the management well, and I'm very confident to say that they've done a fantastic job. They've been a leader in the consolidation of the banking sector in the country, and today they have more than a third market share. So not only is it a very cheap stock, but it also has real growth opportunities. And I think it's another example of a company that could have a dramatically different valuation at some point in the not distant future. Bob mentioned that I'm calling in from London. Earlier today, I attended the investor day here of Ocado. We started following this company in 2013, and we invested for the first time in 2017, and we recently added to the position. It is a revolutionary logistics company that's changing how the world's best grocers operate their e-commerce businesses, which is the fastest growing side of operations for grocers. Grocery e-commerce is a lot more complex than most e-commerce. And because of that, it's usually unprofitable. But Ocado is a 22-year-old company that operates highly efficient and therefore profitable e-commerce logistics. They do this through robotics and through massive centralization, building warehouses that are the size of more than 20 hypermarkets. When we first looked at this company, they were just an online grocer in England, but there has been a significant evolution over the years. In the last 5 years, it expanded into 10 countries, which includes the most competitive markets in the world, like the US and Canada and Japan and Korea. And in each of these markets, they've partnered with the best grocer in the market. And they sell these top grocers both hardware and software. So that means just in the last 3 years, they've gone from being a $3 billion revenue business in the UK to a new business model in which they're paid to build and maintain operating infrastructure for other grocers, in which they've now built a $10 billion revenue capacity business on their way to building a $30 billion revenue capacity business. It was really exciting for me to get to sit down with their management earlier and hear about some of the innovations that they're employing in order to do this as efficiently and profitably as possible. And it was great because it affirmed what our years of study into this business have revealed to us. By my estimates, they're going to earn around 50 cents in 2024 and $1 in 2026. And yet the stock had recently traded down to $5 and it's only modestly higher today. So I hope this gives a flavor that the Robotti global strategy is replete with these sort of unusual, misunderstood investment ideas, such as specialty logistics technology and a war zone that is going to recover and an off the beaten path emerging market. All of these are bound together by our deep understanding of these businesses and by significantly discounted valuations. So altogether, I think the opportunity set today is the finest that I've seen in years, and I would love to get to discuss it later in this call and in the coming weeks. But for now, Curtis is going to share with us some of what's been on his mind. So thank you.
Well, thanks, Isaac. Welcome, everyone. And thanks for joining us. I'm Curtis Jensen. I think you're getting the sense that even as fundamental investors, we occasionally cast our gaze at the macro horizon. I'm reading a book called The Price of Time. It's a fascinating account of the somewhat controversial history of interest rates and central banking. And it really is kind of a stark reminder. Bob talked about discounted cash flow as the North Star for investors. And I think what ties that North Star together is our interest rates. And this book really puts that in stark relief. Yet prior to this year, interest rates were really non-existent for almost a dozen years. Central banks had repressed rates to the point that tens of trillions of dollars of debt carried negative yields. This distortion really caused a speculative orgy in almost everything. Today, interest rates are normalizing. Capital is no longer free. Investors actually have alternatives. And as Bob mentioned, price discovery is being forced into the markets. That's creating temporary dislocations in risk assets like stocks. And that's actually really good news for managers like Robotti who seek out idiosyncratic risks. I don't have a crystal ball for sure, but I do tend to agree with the view, and I think it's shared by Bob and others. Got a strong belief that the next 10 years in the stock market are not going to look like the last 10. Just too many allocation strategies were riding on this fairy tale of low interest rates, Fed rescues, and it affected everything from stocks to bonds, venture capital to private equity. And I think so. Bob Dylan might have said it best in 1963 when he said, "Times are a changing." I've got kind of a list of reasons for my thinking. I've put a few on this slide. I'd be happy to talk about it, in our Q&A, a little more detail in our Q&A session or offline. Um, all of that might sound a little bit glum and pessimistic, but I'm steadfastly optimistic about our investments because they include companies that are competitively entrenched, they're well financed, they're run by management teams who think and act like owners. In most cases, those executives have multiple levers on which they can pull to create value in the business, both operationally and in terms of capital allocation. The stocks themselves remain discounted to any kind of conservative estimate of underlying intrinsic value. So all of these ingredients or elements are, what I think of as my sleep at night factors. There's another filter that I use. I call it the Bob Kirby acid test. Bob Kirby helped to build the Capital Group in Los Angeles, and he posed a question at one of his talks that I think really cuts to the essence of long-term investing. And it was something like the following. He said, would I be happy to own the whole company at the current price, knowing that I couldn't rely on a change in market sentiment or a change in market multiples to help my investing? I thought that was really kind of an eloquent way of describing long-term investing. I've got two examples that embody what I'm talking about. I think they share some similarities in that they are multi-generational. Today, they're both remain family controlled. And I think that family control has allowed the management teams of these companies to really invest with a long-term view in mind. They're not beholden to sort of quarter-to-quarter results. U-Haul's a name that's probably familiar to most, if not all of you. It's the largest do-it-yourself moving and storage company in North America. It was founded after World War II. And today, Joe Schoen, who's the son of the founder, is the CEO. Management's continuously reinvested profits in the business for decades and decades. And in doing so, they've really built a fortress of a company with years of growth ahead of it. I think it's impossible to replicate this business beyond sort of the massive physical infrastructure and the technology that's embedded in it. It's really hard for any competitor to match U-Haul's low cost and convenience. There is a degree of recession resistance in this business as well. I initiated a position in U-Haul shares in 2018, added to it in the downturn in 2020, and added heavily to it again this year. So now it is one of our top holdings. By any conservative measure, I'd say the shares remain discounted by the public markets. Exor is is the Agnelli family holding company. It owns a $9 billion stake in Ferrari. It owns a stake in ag equipment company CNH and auto OEM Stellantis. It also owns Italian football club Juventus, The Economist magazine, as well as other media properties and a host of other assets. I think holding companies like Exor can be really interesting. They can give you low-cost access to unique assets. The CEO here, John Elkann, has greatly simplified what had been a sprawling set of investments, and he surrounded himself with terrific executives. The big event in 2022 was the sale of PartnerRe for $9 billion in cash. Today, Exor shares traded at a 30 to 35% discount to the sum of its constituent parts. I love getting free stuff, and there's lots of free stuff here. The cash hoard at Exor ought to impart, some downside protection in the investment, and it imparts a lot of optionality and flexibility for the management team as well. Management's had a good record of compounding, and if history rhymes at all, I think the odds of a satisfactory outcome are good. Both U-Haul and Exor can create business value irrespective of what's happening in the stock market. And I think the sale of PartnerRe is evidence of that. Management was able to get a very full valuation despite all the turbulence this year. And I guess lastly, I'd finish up by commenting on circling back to Bob's comment on culture, I think the most important aspect of me joining Robotti when I was considering a firm was finding good people. That was my number one criteria. And I define that as finding people who are financially conservative, people who evidence the highest levels of integrity, and people who are passionate about investing. And I was lucky enough to find that combination at Robotti. I think it's a rare combination. So we've got a great culture here. And I think as, fundamental value conscious investors, we've got a very bright future ahead of us. So I want to thank you for listening, and I want to turn it over to David and Theo.
Thank you, Curtis. As I'm switching over to our slideshow here, just want to remind everyone that please put your questions in the Q&A. We're hoping to have a lively discussion on all that once we get to the Q&A session, once we're all done with our portions here. But my name's Theo Vandermeer. I'm a portfolio manager here at Robotti. Last year, we introduced you to the Robotti Select Value strategy. This is a strategy that we started in September of 2021, and it's bringing the same Robotti investment style to a slightly wider audience. And while we believe that investors should focus on their best ideas, we also realize that risk profiles are different for different investors. And so to that end, we created a less concentrated and more benchmark aware strategy, utilizing the same investment process of looking for companies trading at a discount to their intrinsic value. And by leveraging the depth of the Robotti investment team to find attractive ideas across many different industries. We truly believe that in today's environment, there are opportunities across the board, and we are excited and energized in our search to uncover them. I'll hand it over to David Kessler to explain why we're so excited about our positions today. David?
Thank you, Theo. So we've heard from 3 Robotti PMs so far, and each of us shares a common investment philosophy, even if expressed in a slightly different way. As fundamental value investors, however, we've all faced one of the longest cycles in history where value has been out of favor, and it's been painful. And although we know going in that value has and always will face periods of underperformance, as humans, we're conditioned to flee from pain. And whether it's the internal fear of failing or the external fear of being fired by your boss or by your clients, the pain of underperformance is too much for many to endure. And one thing experience has taught me, it's that if you're unable to remain passionate, retain conviction, and stay consistent to what you know to be true, you can't be a successful value investor. Now here at Robotti, we're incredibly lucky and thankful that not only do we have the right boss, one who's kept the firm single-mindedly focused for almost 40 years when it comes to investment philosophy, but importantly, we also have the right clients who allow us to continue investing with conviction even through these painful times. Now, there's been no place to hide in 2022. Every asset class, large cap, small cap, growth, value, fixed income, they've all felt the impact of rising interest rates, quantitative tightening, supply chain disruptions, and the global effects of the invasion of Ukraine. In fact, the Russell 2000 mid small cap index fell more than 25% through the end of the third quarter, making it one of the worst performances in the first 9 months of any year in history. And while it's rebounded a bit, it's still down more than 16% for the year. Now, there is one thing I want to point out. We often talk about a behavioral advantage that allows us to take advantage of what's often called time horizon arbitrage. So having a different, in many cases, a longer time horizon than most of the market. And we usually discuss that in reference to a specific stock. But we can see on the lower right-hand corner of this slide, it also applies on a higher level from a recent study of Bank of America, which shows that a longer time horizon significantly reduces the chances of having a negative portfolio return. But going back to what Bob mentioned earlier, one of the core common values that aligns every investment professional at Robotti is that we fundamentally believe that valuation matters, most of all over the long term. So let's look at some very simple metrics to help reveal why we're so excited about the opportunity facing us. Quickly looking at valuation levels of mid-small cap stocks, not only is the forward price to earnings ratio well below its 25-year average, but it's within range of its 25-year low. And taking a look at mid-small cap stocks in general, it's clear that value stocks traded at a large discount to small cap growth stocks. I have dozens of charts like this that provide evidence why mid-small cap value stocks, the exact place where Robotti has a successful history of investing for the last 40 years, is extraordinarily cheap. The pond where we fish is literally jumping with opportunities. And Theo, Bob, and I have been busy this year investing the new portfolio. And one area where we've seen opportunity is in the mid-small cap consumer discretionary sector, where on whole, it sells for a discount to its historical average and a discount relative to its larger cap peers. So after sifting through dozens of ideas, we found one opportunity, which is Academy Sports, a leading regional sporting goods retailer in the southeastern United States. The company was bought by KKR from its founding family in 2011, and KKR took the company public in 2020, exiting the investment. The market's currently gripped with fears of inflation, rising interest rates, and the possibility of a recession, and how all of this might affect consumer spending. And as a result, shares of Academy are selling for just over 6 times 2023 consensus earnings. In 2019, the company hired retail veteran Ken Hicks as CEO, who was the former CEO of Foot Locker during a period where the stock quintupled. There's been a lot of low-hanging fruit to attack, and Hicks has done this by implementing the Retail 101 strategies he's had success with during his distinguished career. Now, after not opening any new stores for the past 3 years, the company plans to open 80 to 100 new stores over the next 5. Academy also caters to a more price and value focused consumer, which should help in the current environment when you're probably still going to buy your kid a baseball glove for Little League, even if you may be looking to spend less. Free cash flow has been used to repurchase shares, implement a dividend, and reshape the balance sheet by aggressively paying down debt. Now, we think that 6 times forward earnings is very cheap for this business in general, but given the significant opportunities to continue expanding margins, prudently allocating capital, and resuming store growth, Academy Sports is an extraordinary investment opportunity. I'll pass it back to Theo now, who will discuss another portfolio investment.
Thanks, David. So another company that we own in the Robotti Select Value strategy is AirCap Holdings. And we first started looking at this company in the throes of COVID, when it seemed that air travel was never going to come back, or at least securities were priced in a way that was saying that they would never come back. They're the largest aircraft leasing company in the world with over 3,500 aircraft, and are operating in an environment that has experienced a multi-year period of supply constraints, significantly changing the value of existing assets out in the market. As air travel continues to recover in a post-pandemic world, the demand on their assets continues to grow. The well-capitalized nature of the business versus their more constrained airline customers provides further avenues for growth in the form of sale, leaseback, and other endeavors. And while with normalized earnings and cash flow, the company is cheaply valued without getting a premium for its industry-leading platform. There is also a potential hidden asset in the form of a substantial insurance claim on planes seized by Russia at the beginning of the Ukraine conflict that have already been fully written off of AirCap's books. As always, we're happy to drill down on this company, Academy Sports, or any of the companies that we hold if you have any questions. So again, please feel free to submit them or talk to us after the meeting. But for now, I'll turn the call back over to Bob. So Bob?
So everybody could see that, right? Cyclicality amplifies amidst the market's manic depressive nature. So here's a quote from Ben Graham back in 1934. And the point he's making here is that volatility in businesses and cycles mean that at points when the business is difficult, the market reacts to that and depresses the public security price dramatically. So that means that you can buy a business frequently that is a substantial discount to what it would cost to build that business, given the difficult economic environments a company is going through. Of course, you want to make sure it's not a buggy whip, so that therefore there really is a recovery in that business. The second slide here is Schumter talks about, so the concept is kind of Mr. Inside, Mr. Outside. So the first one is Mr. Outside, and that is what the market does and how it discounts securities and gives you an opportunity to buy businesses. Here, what it talks about is when those businesses are going through difficult times, what happens in those businesses? And so that's what, when those businesses are in a difficult situation, there's a cathartic process that goes on. There's right sizing, downsizing, and consolidation. So therefore, you start to fundamentally change the supply demand dynamics of that company and that industry to improve the earnings power of the assets for those remaining players. The consolidation adds to that. What we'd also highlight is, once again, this extended period of economic environment in the backdrop has meant that the down cycle has been extenuated. So therefore, instead of recovery that normally might have happened, you've had repeating downsizing. So there's been a substantial underinvestment in a number of these industries and businesses that we're invested in today, so that in many cases, there's even a structural change to the business, and therefore the volatility and the cyclicality are substantially less, at least for an extended amount of time, because there's a hesitancy for capital to come back in. In cyclical businesses, it's well known that the cure for high prices is high prices, because that brings in new capital and therefore destroys the returns, or at least moderates the returns. There are plenty of reasons in these businesses, given how they can have consolidated down, that are restricting the normal flow that normally happens here. So what we also do is we're not just looking to buy a business that's going through a difficult time and has that cathartic process, is consolidating, is restructuring its business, and is being discounted by the market. But we also look for a business that has something about it that's different, whether that's a product, whether that's a service, whether that's a management, whether that's an owner, or in many cases, all of those factors, and therefore facilitate being able to extend the recovery and potentially have a different transformed business, given how management responds and what it's done. And that's what we've done repeatedly. So the first company I want to talk to you about is Subsea 7. Subsea 7, we think, has all these attributes: an industry that's been underinvested for an extended amount of time, a business that has a very strong balance sheet, has an owner operator, through the downturn has deployed capital to substantially increase the earnings power of the business. Competitors gone away, so there's a huge consolidation, so there's a differentiation. There are really, at the top end of the market, two players that have a very differentiated product offering, and many of the business contracts they're doing today are sole sourced. There is a company that's working only with them. The business itself also, we think, is broadened, because not only is offshore oil economic today, offshore natural gas fields are economic too. So the scope and the addressable market is substantially larger than it has been. So it has all of these dynamics that we talk about, and yet it has the market discounting heavily this business. The earnings power of this business in the last cycle was over $2 a share. We think the earnings power clearly is dramatically higher today, given the things they've done and the position they have. So you have a $10 stock that we think earns well over $2 a share, and from there has significant growth, given there's also things like life of field. So it's not just developing the field, but it's also the 20 years of the life that the field's producing. Their involvement is extenuating and deepening in that business, and they have much better position. So therefore, the nature of the business is changing, and investors don't recognize that. In addition, with Subsea 7, it also gives us conviction on a number of other securities in our portfolio, because the visibility it gives us into, and the conviction in terms of the ramp up in activity offshore, we think is clear, demonstrable. And Subsea 7 has played a role in that. What they've done is help reduce the cost to develop a field, where in 2014, $100 oil meant the cost $100 to develop the field. It wasn't economic. Over time, by redesigning those projects, how they're done, by changing the structure, by intervening on an early basis into these projects and redesigning and standardizing, mean that today, many of the fields that have been discovered a long time ago are economic at $30 oil. And that's what sets up the base. $30 oil is what you need for economics. If you have 80, 90, or 100, you can have a substantial reduction in the price and still have a very economic field, so that therefore you've got conviction. The majors have conviction in terms of expanding and committing to projects, and therefore filling this backlog that is very much filling up today. So that's a highlighted example. Another company that we talk about is revenge of the old economy, because that's what it is yeah, we live in a digital world, and yes, technology is wonderful, but the fact of the matter is there's a tangible aspect of it that hasn't gone away. We need physical, tangible things. So one industry is the chlor-alkali business. Olin is a great example of an old economy company, cyclical, that people don't like, that hasn't had good returns almost forever. In the last 3 years, that business has been transformed. Why? Because high cost is the energy costs. They're in North America, so that's another component of the fact that we are, I believe, today in an interesting place with energy, but North America is competitively advantaged. So you have an industry that's consolidated down to 3 guys controlling most of the market, and the U.S. producers have a substantial cost advantage over the rest of the world, and that's what you have. A company that says we'll generate 1.1 billion in free cash flow this year, 1.1 billion in free cash flow, And yet the market cap of the company today is $7.7 billion. So its depressed earnings give it a double-digit free cash flow yield. In a normal environment, this business probably does $2 billion a year. So therefore, it is substantially undervalued. Strong balance sheet. What are they doing with the money? They're not adding new capacity, therefore, to upset the balance they have in the market in terms of supply demand. Instead, they're buying back stock. They bought back 14% of the shares over the last year and have accelerated that in the last 2 quarters. So that's what they're doing, is they're increasing the per share value of that business, the intrinsic value per share of that business, while the market is not paying attention and is doing something different. So therefore, there's an opportunity set that they're able to execute on today that continues to increase the value of this company with an extremely modest valuation. So those are just 2 examples of companies that we think highlight what we think is broad across not only my portfolio, but all the portfolios, securities that are misread. In the meantime, the market doesn't believe it. The market has been invested elsewhere. The market is not looking at these places. We see that when we do earnings calls or we go visit companies, the dearth of people who are interested in these businesses is glaring. But again, valuation matters. Free cash flow is something that people will eventually focus in on. It will attract capital. The valuations will adjust. In the meantime, as I said, they're doing something with that free cash flow that's further increasing, consolidating the businesses, buying back stock, and increasing the per share earnings of those businesses. With that, we'll go. Before I do leave, one other comment. Susan Kaplan has been my assistant for over 10 years, and Susan has given us that indication that she'd like to take time and enjoy smell the flowers and be out there. So at the end of the month, this month she'll be retiring. So many of you may know Susan. So feel free to reach out and of course wish her the best in the next stage of her life. Thank you so much. And questions, Theo? Are you gonna handle that process?
Yeah, right here.
Thank you.
You want to just take down your slides so everyone can see our wonderful faces? There we go. So our first question is, are the companies you're invested in suffering from noticeable talent shortages or problems related to remote work? How are management teams handling this? And I guess before I kind of hand this off to everyone, I guess I would just say that the labor has been a constraint for many of the businesses we're invested in across the board. And as Bob talked about, one of the focuses is on these old economy names. And those by and large don't have the ability to have remote work. You really need people on site to build things, on production lines. And so that hasn't affected many of the businesses that we're invested in. But a good example of how this has affected some of our businesses is in manufactured housing. They've seen huge increases in demand over the last few years, and their main constraint has really been access to labor and getting that labor. And this has led to an increase in labor costs. But they've been able to do this while passing along much of that cost and maintaining their margins. And also it's kept the industry from kind of overextending itself in some ways. So that's a quick answer for me, but I'll hand it off to Bob to correct me. And
quickly, I'll correct you there. They haven't been able to maintain margins, right, in the last 2 years, given the demand for housing, given the cost advantage nature of the home they make, which is far below what it costs to build on site. They've been able to capture the advantage that they have. They've raised prices dramatically. Margins have expanded dramatically, and those are probably sustainable. And the current environment probably means the things that were constraints, availability to building supplies, clearly is dissipated given the slowdown that's happened. Their difference in terms of the product they have and the price offering they have is dramatic. They're able to now continue to hire people. And so therefore, over time, they've actually been able to build up the labor force. So the constraints they had are dissipating. The opportunity is the pricing advantage they've had. They capture that value. Margins have expanded and the cash flows are improved and we believe sustainable.
Great. So another question we have is, there's been a reluctance to invest in oil and gas due to transitions to clean energy. How does this change the prospects for subsea long term?
We think that that concern clearly is identifiable, accurate, and so there is a concern, right? I would point out that I think the world has responded to that, and the world's response to that is to constrain the development of every other form of energy. We've built out renewables, and that needs to be done because the transition is something that is absolutely required. And I think, given the high price of fossil fuels today, it will accelerate that, and it will facilitate it, given it becomes even more economic, and that's a wonderful thing because the world is short of energy in all forms, renewable and traditional. And of course, what set that up is the concern about CO2 has constrained. And that's what you have, right? 80% of energy in the world today is generated from the burning of a fossil fuel. And another significant portion of it comes from nuclear power. Both of those sources over the last decade have been things that people have underinvested in because of the concern about the environment. Valid concern, absolutely. But what you've done is you've limited the availability of energy that is required across the world. Look at what's going on in Europe today. And of course, it's not just Europe. Look at what's going on in Asia today. So the prices of fossil fuels, because that's a key element. You know, the next 10 years, we're not eliminating that. You can't, right? And so therefore, the world's underinvested, and therefore that's what set this up. And we'll see an acceleration. Now, of course, Subsea 7, right, what they've done is they're a significant player in the renewable business, right? A quarter of their business today is the installation of fixed offshore wind. So they are clearly a player. And then what they've done is repurposed assets they already had. So they didn't have to really buy into a new business and create new capacity. They just repurposed from some of the oil and gas business they've done. What that also does is we see what's happening in their business in the offshore wind business. The costs of that are going up dramatically. So for the first time, right, over an extended period of time, costs of renewables had been declining, therefore becoming more economic. For the time being, the cost of renewables is increasing for many reasons, because there's an upfront capital cost and there's a physical demand, right? When you do an offshore wind tower, right, you have to put huge amounts of cement, a huge piece of steel. You have to go out and get a boat for $500 million to install the turbine on top of that tower. That is capital intensive. That is commodity intensive. That is steel and cement that therefore burn CO, they'll cause new CO2. So there's an exit tax effectively being exerted. In the meantime, the cost of wind is also going up. And so therefore, all these energy sources, of course, are costing more money. What people will say, oh, gee, but aren't you concerned about the slowdown in the economy and therefore what that might do to mitigate oil and gas demands? And to there, I'd actually say, you missed it. The last 4 quarters, there's been a recession that's been going on, and probably the economy that drives most of the industrial things we're talking about in the commodities, and that's China. So therefore, they've been locked down in COVID. They've had economic hurdles, and you know that because emissions were down 8% in Russia and China. And so that means economic activity has been slowed. They're seeing now what the rest of the world saw in 2000, 2001 in response to the onset of COVID. It didn't happen in China. Energy consumption and the consumption of everything, all fossil fuels grew in China in 20 and 21. And therefore now finally there's a catch up. That's not the new norm in China. And so therefore we already are suffering through a recession that affects many of the businesses we're invested in. So you see those earnings are depressed earnings given the most important economy in the world and the largest, one of the largest energy consumers and the marginal consumer is in a recession.
Our next question is for Curtis. And they're wondering, could you comment on U-Haul's majority owners' treatment of minority holders?
Yeah, sure. It's a subject I'm sensitive to because I own a number of companies where there is a majority owner. There's nothing to indicate here to me. I mean, there isn't anything in the track record that would tell me that there's been mistreatment or abuse of the minority shareholders. And in fact, the executive team is, paid very modestly in my mind. They don't get stock options, which I think is highly unusual in among U.S. companies. And so at least where Joe Schoen, the CEO, is concerned, the vast majority of his personal net worth and his incentives are in the stock of the company. And as far as anything nefarious, transferring assets or anything like that, I haven't seen any signs of that. So I'm very comfortable that they're well aligned with the passive outside shareholders.
Yeah. U-Haul, I'm sure, is an example of Wall Street may not like it because they want the businesses separated. If some of the parts are worth more money, so you could change all of those things. Instead, this is a long-term owner allocating capital, running the business the way you should run a business. And therefore, in the short term, potentially that doesn't kick the stock up. But that's what I'm guessing is they're actually doing a great job doing the things. That's how you really run them. And that's how they build value. And that's why it's so that concern maybe even gives the opportunity to have an entry point into guys who are great stewards of the business, who understand their business, who have a demonstrated record of growing that business successfully and being great managers.
I mean, part of the opportunity with a company like both with Exor and U-Haul is the fact that they are majority controlled means a lot of institutions can't or won't own those stocks. That their governance won't allow them to own stocks like that. As a result, a lot of demand for that stock is absent. It creates a great opportunity for investors like us.
I guess actually,
and in those cases, the long-term record and the capital allocation becomes its own evidence of what the corporate governance is. Corporate governance is evidenced by how they've reinvested, how they've paid out dividends, respected bondholders, all those different elements.
I agree with that. Yeah.
that actually kind of leads into our next question pretty well. We have a couple questions talking about how ESG enters into our philosophy and how that affects companies like Subsea or Olin, and in general, how we think about ESG.
The concerns about the environment, your community, your employees, all those things are extremely valid concerns. And so, we do think about who the business, who runs those businesses, how they run their business, how they allocate capital. So I will tell you that I think one of the opportunities really in the energy business is mitigation, right? How do you mitigate CO2 and still produce energy? Because the world needs energy, and how do you do that more efficiently? And therefore, I think that many of the energy companies that I'm invested in, so for example, I just told you, offshore wind is a big part of the business of Subsea 7, but even their own core business, they're retrofitting one of the largest vessels that's going to substantially reduce the CO2 that it generates in the process of operations. There's a number of projects that companies are unveiling, so that they are doing things to change because they identify this issue too, and they're not. In spite of what people may say, they stick their heads in the sand. They're not. They're replying to this and thinking about it, and they play a key role. They're in the front line, and they have the ability to influence it, and they are intent on it. The other thing I will point out is, offshore oil and gas developments are probably the lowest carbon generation of any kind of production, because of course the impact on how much activity, how much you have to do onshore drilling in the United States is something that is very activity intensive, and therefore generates much more CO2 per barrel of oil produced or natural gas produced. So therefore that segment of the market probably is advantaged. It mitigates. It isn't as disadvantaged, right? I'm not saying they're cleaning up the environment and eliminating CO2. They're not, but they're providing energy, reliable energy to people who need that. And that's a critical element. And the balancing those two things is something I think the world is seeing today. How do you balance those two things? And that's critical. So how do you continue to provide energy? And how do you do that in the most or the least impactful way? And I think that has gotten people's attention, and they're responding accordingly.
Right. So I'm going to try and combine two questions here. This one will be for David about Academy Sports. So the two questions are, how do we think about moats when we look at these value stocks? And a company like ASO, what's the moat for a sporting goods store? There seems like there are a lot of them there. And then another part of this question is, with the stores that they plan on opening over the next 5 years, how do they have confidence in consumer behaviors over that period of time? How much of the impetus of the thesis is based on Ken Hicks and him being in charge?
Thanks, Theo. So I'll answer the second part first. Their confidence in opening new stores, they have not opened any in the past 3 years. Of course, 5 years is a long period of time. Who knows what can happen over the next 5 years, but that is their plan right now. It's something that seems entirely reasonable. Right now, Academy Sports is heavily concentrated in the southeastern part of the United States. And what they've been doing is expanding at the seams, growing out into either states that they're in where they're not heavily concentrated or into new states. And so there's plenty of room for them to continue expanding right now. And it's something that we have high confidence that they'll be able to do. In terms of Ken Hicks, I think Ken Hicks has been incredible. It is a concern of mine that I don't know how long he'll stay there for, but I think what he's done is put the company on the right track. And I think by doing that, the company will continue to follow kind of the policies that he's put in place and the kind of the take from his lead, and can be able to continue to improve this business that really, it seems, that had not really been invested in for a very long time. And where it's really is known as in certain states as the sporting goods store that everyone grew up with, and be able to continue improving upon that brand name. In terms of moats, so it's interesting. Before COVID, I would attend or speak at different value conferences. And I remember two of the most talked about stocks at the time were two extremely wide moat companies, Carvana or Wayfair. And both are down 90% now. And I think what happened is a lot of people forgot that valuation matters. I think that if we look back, there's always been periods of time where people get very excited about things looking forward for a very long period of time. And there's always been a type of investing, that type of investing that makes sense, but that's more growthy investing. We're talking about a sporting goods retailer that's trading at 6 times earnings. If we look out long-term, based on market multiples, based on average retailers, it's cheap by any metric. But given the opportunities that it has in front of it, it's extraordinarily cheap. And in terms of, in terms of the moat that it has compared to other sporting retailers, so if you look, a lot of sporting retailers have gone out of business recently. We have Sports Authority or Champs, and yes, Dick's is another competitor. I think there's enough room in the United States for 2 sporting good major chains. But I think the advantage that Academy has right now is that they're more focused on the price conscious consumer. And going into the type of environment that we're entering right now, I think that is definitely puts them in a great position to be able to cater to the consumer in a time when many people are worried about inflation, what's happening in the economy.
Great, thank you. Bob, we have a question about builders asking for an update, and has the position size changed over the year? And also, what's the impact of rising mortgage rates on the business?
Well, obviously, the impact of rising mortgage rates is it's slowing down activity, without a doubt. Of course, the company recently came out and at the end of the year did say if there's a 20% reduction. So for the trailing year and a half, they've generated $3.3 billion. Valuation matters, right? For the past year and a half, they generated $3.3 billion in free cash. With that, they bought back 30% of the outstanding shares of the company. Today, the company has a valuation of a little over $9 billion. With a 20% decline in the business next year, they'll do better than $1 billion in free cash. So activity is slowing down. The company has a differentiated product offering. Labor is one of the things people asked about before. Building homes, one of the constraints for the last number of years has been labor. That is one of the things that sets Builders FirstSource apart. A significant part of their business is making components. So they're working wall panels, floor panels, roof trusses, and delivering to the job site. So there's less labor. The labor you need is less skilled in terms of its efficiency, therefore costs less money. You have less waste in terms of the product, an ESG advantage, right? You don't throw things in a dumpster. You're using less materials to build a home. So there's a very different way that they help builders address their end markets, reducing mitigating the cost increases that's happened, reducing labor, and reducing the cycle time to build a home. Those are all advantages and different. In the meantime, the market share that they have positions them really well, and the balance sheet enables them, as the business slows down, to respond. And they've done that. And one of the things is inventories, right? Inventories are very modest because they've seen this coming and they've been able to deliver. And there's still a backlog of demand to complete the homes under construction. So we think there's plenty of visibility. The valuation is clear and discounted, and therefore we think it's an excellent opportunity today, and especially in terms of its valuation.
Thank you. We have a question about a company that we actually didn't discuss today. GrafTech took a hit partly due to an issue with their operations in Mexico, and they're just wondering how long will this turnaround take, and how long will it take for the company to recover?
Thanks, Theo. I don't know if you saw, but actually last week, GrafTech was allowed to restart the facility. So that was great news. It was a surprise that it was shut down. I'm not exactly sure. I believe that they said, and this was whatever was consistent with what they said on the call is what the effect is going to be for the quarter. I think it was 10,000 to 12,000 metric tons of delivery will be affected for this quarter, but it's something that should be worked out within the next quarter or two. The stock was actually up 30% on the news yesterday. And it was nice to see that they will be bringing that back online. They said that there will be more news on that going forward.
Great.
So let me, I see one or two questions that kind of tie into the same thing. And one of the questions is, how would you compare Subsea 7 to Noble? So maybe I'll address that one. And they're the same end market demand is driving the improving outlook of both of those companies. They're both substantially undervalued today, but they're different, right? Because Noble owns offshore drilling rigs, and there's a number of companies. Now, of course, the number of companies has dramatically consolidated. The industry is in a good position today. However, there's nothing different between Noble's rigs and Transocean's rigs and Valaris's rigs and everybody else's rigs. So there's a certain commonality. Of course, the demand for all of the high-end equipment in all of that industry is being used today, and therefore that's what you have. You're at this point where the demand is absorbing all the available top quality supply, and therefore that hits price. And so therefore prices are dramatically increasing. And as prices increase dramatically for the product, that means the margins go up because the costs really don't go up very much. And so I think that happens for a while. So businesses like offshore boats, Tidewater, offshore rigs, Noble, all of those are extremely well positioned today because the demand continues to grow, the availability limited. The idea that someone's going to go out and build a new rig or a new boat is constrained by the fact that there is uncertainty longer term for how long. You don't build a 30-year asset that you have visibility in the next 5 to 10 years, but it gets foggy after that. And on things like a boat, you don't know what power source to use. So there are constraining factors on a number of these capital goods that mean there should be an extended period of time. There should be increasing profitability, increasing free cash flows, strong balance sheets in both of all those businesses as is, and potentially higher for longer because you're not going to go out and build new, and pricing for new is still substantially above where pricing is today. So I think prices and therefore profitability continue to expand. Subsea 7, same dynamic, but there's only two companies and really only one that does what they do. And so therefore that differentiation means that there's extra profit potential and sustainability in that, and probably makes Subsea 7 an interesting company eventually for another company where they have a very close alliance, and that is Schlumberger or the new SLB. And because that fully integrated product offering is a critical differentiator, and so therefore something really of interest, which is also driving the economics of Subsea 7 and improving profitability. So similar, and as I said, Noble, whether that's rigs or Tidewater or boats, there's a similar market dynamic that's occurring in both of those businesses today.
Great, thank you. So there's actually a question on here for me, so I'll just ask myself. Someone's asking if I can elaborate on the concept of grassroots macroeconomics as I see it. And basically what we mean when we say that, it's the idea that the companies operating in an industry are likely to be more knowledgeable than the media or even economist prognosticators about what will happen in the macro. And by researching the individual players, including the suppliers, the customers, and the competitors, that gives us a better understanding of the macro environment from the bottom up. It's kind of the equivalent of studying the structural integrity of a house by looking at each of the individual pieces and components, as opposed to inspecting it by walking around the outside and just seeing if it looks okay. So that's what we mean when we say that. It's really by looking at the individual companies and letting that dictate some of our investment. So we actually have a follow-up question on builders, specifically asking about the CEO stepping down in the past week, and what that's indicative of and how we're thinking about that. So,
yeah. So I think we'll see in the next week that his great success with Builders First Source and its results in recent times has attracted headhunters, and therefore people have identified him clearly as a CEO who's added value, and therefore he's been recruited away. That I think is the case. That said, the critical question is, okay, so if he's a great executive and someone saw him and recruited him away, what does that mean for Builders First Source? I do think the key differentiator in Builders First Source is the nature of the business they have and the market position they have. That business, right, having been a director of, one of the component companies, BMC, from 2012 to 2015, and visited 30 different locations around the country that are part of the Builders First Source business profile today, give me a conviction that the key integral part of that business is decentralized. It's the guy who runs the business in Dallas, it's the guy who runs the business in Houston, it's the guy who runs the business in Seattle, the guy who runs the business in Charlotte. So those market managers are critical people who know the customers, know the relationships, know the products sold in market, and that's your real differentiator. And the market position each of those companies, each of those locations has in their market, that's what makes it. So kind of like it's an analogy to Buffett's comment about, if you have a horrible business and a great manager, it's normally the business that keeps its reputation, not the manager. So it's the same thing here to a certain extent. I don't want to in any way minimize the CEO and the role he plays. The fact of the matter is the nature of that business, their market positioning, the decentralized management, that's the critical element, which is, of course, one of the strengths of the business, because some of those people eventually, of course, will retire and get recruited away. The fact of the matter is the size, the scale, the scope, the depth of the organization means that they are well positioned without regard to, and they can adjust to the fact that they'll need a new CEO.
Great. So the next one is kind of a fun one that I'll open to anyone who wants to take it. But we have someone who's asking if Meta is a value stock now, as it's valued at 6.5 times EV to EBITDA. And is that anything we're looking at?
Well, we're less than a majority of the total the stock pickers at Robotti and Company. I can tell you for sure, I hear from a number of those people where they've mentioned that stock to me repeatedly. And so, of course, that's what it is. We're in an environment where people they follow the numbers. The numbers clearly are intriguing in that business. And therefore, there are people who are proponents of that idea. And that's what happens, right? What is in each of our portfolios is predicated eventually on what Curtis decides to buy, what David and Theo decide to buy, what Isaac decides to buy. And so that's what it is. There's a commonality and there's a sharing, but portfolios are run by a portfolio manager who makes that individual decision. I've always used the phrase, you have wonderful kids. I love your kids. They're wonderful, but I like mine better. And so that's what it comes down to eventually. Is we don't own the same stock. Sometimes we do. Sometimes there's an overlap, but frequently there's not. So therefore, that's an individual decision. And that's critical because it's not a stock that makes a portfolio. It's a portfolio manager that makes a portfolio. So therefore, to have the sanctity of that, to have that sole purpose, that person making that decision, 39 years, I've done this. I think that's a critical element in aggregate success. It's not the stock you own. It's the person, their understanding, and what they decide to do. That's the critical element. So Meta is definitely something that there's someone here who pesters me like repeatedly about that idea, who's a huge proponent of it. And also has a clearly better sense of the business because what the hell do I know about Meta or Facebook? I'm not a Facebook subscriber, but some other people do. So that's part of I think the huge value add that we do have. All of us share ideas and we may not agree with each other, but what do you think and how do you think that? And I have to understand that. And if I understand that, I am a better portfolio manager, even if I don't own that particular stock.
Great. So we are running a little long here. I know that there are still questions in the Q&A. We haven't forgotten about those. We'll reach out directly and answer any of the leftover questions that we have here. I'm sorry that we didn't get to all of them. But until then, I'll hand it over to Bob, maybe for some closing remarks. Bob?
Okay. Thank you all for joining us. Thank you for your interest. So I said it, like what I really think is stock picking is really the key differentiator for all of us, right? It's understanding the business you're invested in. knowing that business, having an appreciation for the future cash flows and the valuation that the market is giving you for something that is substantially discounted. And that's a commonality that we all have. And so I'm excited because that's where I think we are. I think many of the companies we have are very different businesses that have therefore barriers to entry. Barriers to entry means higher returns over time, less volatility in the earnings. So as Buffett talks about, a better business. And so I think we have most of our portfolio are better businesses. At the same time, the valuations on those businesses today, I think, are disconnected from the economic reality and substantially discounted. So I would equate them to almost what Ben Graham talked about as a cigar butt. Right? The valuation is so cheap, but that's what we have, both of those things. We have businesses that are substantially differentiated with barriers to entry and high returns and very modest valuation. So I think in my experience, it's a unique time where you have your cake and eat it too. And therefore, that's why I'm excited about what we own in the future for all of us. Thank you. Happy holiday. Happy Thanksgiving. Happy holidays coming up and Happy New Year soon. It'll be soon enough because time flies. And especially when we're having fun, and we're having fun here. Thank you.